Okay, what we're going to talk about is this latest CPI data release that came out earlier today. It has surprised a lot of people, myself included. And one of the things we want to kind of understand is that the stock market, to me, is operating under like multiverse theory. And what I mean by that is that they're operating under the narrative of that they're not in the world with the rest of it. They're not in this world with everybody else, is what I mean to say. And what I mean by that is that there's a lot of projections that inflation has topped out. We've hit peak inflation. It's only going to go down from here. And they also believe that it's going to accelerate, or the decline is going to accelerate very rapidly. And one of the reasons why they have to do that is they have to keep people invested in this market. You have to understand is that fund managers, media outlets, they have to keep retail invested in the market. You always hear the narrative of, dollar cost averaging. Even if the market is down, you should still continue to buy the dip. Nobody really saying buy the dip anymore as bad as the market's been over the last 7 months. But you hear these narratives of continue to buy into a market that the perception of the future of it is going to be negative. And that's how they have to keep people engaged in the market, because a lot of these people get paid off managing large sums of money. They need inflows still into that particular company. Like if nobody's buying, we can't do an offer. We won't make anything. And then the outlets need something to talk about. And unlike the rest of news, most people don't want their market news to be negative. Now, in mainstream news, it can all be negative. It can be negativity on top of negativity. You can be a really successful YouTube platform just on negativity. However, in the markets, because people are actually invested financially, they a lot of times don't want to hear negative news. The biggest channels for people to give you negative financial news are for people that don't invest in the markets at all. They just consume negative financial news. Like the real estate market's going to fall. Guys put out 30 videos a month about the real estate market going to fall. That's how they make their money. And the people that watch it on real estate investors, they're just consumers of that kind of content. However, they have to put a certain tone on the market. And so what we were getting earlier is a lot of perception from the market, even though Jerome Powell has stated what their goals are, and we got to see if they follow through with that, is that inflation had peaked out. Now, I will admit, I was wrong about this CPI report. I thought it was going to come out at expectations and even lower because of gasoline. And what we saw today is that even with gasoline being lower and even some energy costs being lower, costs in other areas still continue to go up, right? And let's go ahead and get into some of the numbers. So what I'm gonna do is I'm gonna show you this chart real quick, right? And we're looking at CPI data from April 21st to August 22. So April 2021 to August 22, I'm sorry. And we're seeing is that all items peaked around June, and then it started to slope down, okay? Then we look at all items less food and energy, we started to see a little bit of an increase, and we're going to talk about that, all right? And that's what a lot of people were anticipating. So they believe that June was peak inflation, and then from here on out, it's just going to continue to go down. And what we're seeing is that we're not seeing this rapid decline in inflation. And the Fed has said that they're looking to get inflation back at, I want to say, was it 4%? I don't think that's going to be possible, but that's their goal, okay? But if we see that all items less food and energy has gone up to almost where we were at in March of 2022. And if you understand the rate of change, what that actually means, it doesn't mean that prices have to go down. It just means they don't want prices to continue to go up. And I think that's a challenge. So even though gas went down, we're starting to see inflation or the cost in these other areas are starting to continue to increase. So let's go into some articles real quick. So here's the journal. It came out today at 8:43 a.m. So the Labor Department reported its consumer price index rose 8.3 in August from the same month a year ago, down from the 8.5 in July and from 9.1 in June, which is the highest inflation in 4 decades. And that's why the market really slammed down in June, right? And the CPI measures what customers or consumers pay for goods and services. So the so-called CPI, which excludes energy and food, increased 6.3 in August from a year up earlier, up sharply from the 5.9 rate in both June and July, a signal that broad price pressure strengthened. So on a monthly basis, the CPI increased 0.1% in August from July, despite a sharp decline in gasoline prices. And that's why I thought the CPI was going to be lower, because I'm like, well, gas is going to be lower. And I thought that was going to move throughout the whole economy, but maybe gas has not been lower long enough. Maybe we need gas to be lower for a longer period of time. So the core CPI rose from 0.6% in August, double July's pace. And then what I'll really show you quickly here, something we're going to transition into, is at the end of this article, they talk about the broader labor market remains strong, with employers adding 315,000 jobs in August, while the unemployment rate edged up but remained low at 3.7%. So I think this is going to be the dilemma. If inflation continues to remain high, but employers still are hiring people, we're going to get what they were talking about as a wage price spiral, where the consumer or the employee is going to ask for more money because of inflation, which means that the job have to pay them more money to get them to come on the job, which means they have to raise their prices, which means now that gets pushed back to the consumer, and then it becomes a feedback mechanism where prices just keep going up, because to hire people, I got to pay them more money, which means I got to raise my prices, which means those same consumers now got to ask for more money to get hired. And so this is why I was telling people, I think the solution to this problem is to figure out how to create to increase unemployment. And therefore, if I think more people don't have jobs and employers are not looking to grow and hire people, then as a result, that's really how they're going to combat inflation. Okay. Now let's look at the Bureau of Labor Statistics. So they give you some of the data. The CPI rose 0.1% in August on a seasonally adjusted basis after being unchanged in July, which is what they liked. They liked it in July, and I think that's the reason why we were so bullish. It's because it was unchanged. So it meant that they thought it was topping out and had flattened out. So that's that rate of change we're talking about. Over the last 12 months, we know it increased by 8.3%. So increases in shelter, food, and medical care indexes, right? Let me go ahead and get this out of the way. So increases in shelter, food, and medical care indexes were the largest and many contributors to the broad-based monthly all items increase. So these increases were offset by 10.6% decline in the gasoline index. The food index continued to rise, increasing 0.8% over the month. As the food at home index rose 0.7%, the energy index fell 5% over the month as gasoline index declined, but the electricity and natural gas indexes increased. We may know the reason why that took place. So the index for all foods, less food and energy, rose 0.6% in August, a larger increase than in July. And then the indexes for shelter, medical care, household furnishings and operations, new vehicles, motor vehicle insurance, and education were among those that increased over the month. There were some indexes that declined in August, including those for airline fares, communication, and used cars and trucks. And so here we can look at the chart. We see August 2022. We see all items 0.1, food 0.8, July was 1.1, food away from home was 0.7, July was 1.3. I'm sorry, food away from home was 0.7, July was 0.9, food at home was 1.3, July was 0.7. We see energy is negative 5.0, energy commodities negative 10.1, gasoline negative 10.6, fuel oil 5.9. But if we see energy services is 2.1. In July, it was 0.1. Electricity was 1.5. In July, 1.6. Utility gas services, 3.5 in August. In July, was negative 3.6. All items less food and energy. In August, it was 0.6. In July, it was 0.3. Let's see. Let's look at new vehicles. It was 0.8. July, 0.6. Used cars and trucks, 0.1, negative 0.1. In July, negative 0.4. Apparel was 0.2. July, it was negative 0.1. Medical care commodities, 0.2. July was 0.6. Look at shelter, less energy services, 0.6 in August, 0.4 in July. Transportation services, 0.5, negative 0.5 in July, and then 0.8 and 0.4 for medical services in July. And so what we want to understand is that, yes, even though gas went down a lot, I don't think that that's really pushed its way throughout the whole economy. And it may not create the impact that I thought it was going to have. And therefore, it looks like inflation may be here to stay. Going back to this particular chart, let's go back to it. So inflation, all items, it may flatten out, it may decline. All items, less food and energy. Once we pull the energy and the food out, let's see if it keeps going up. And this is what I said, is that I think that the stock market, and we saw this during the pandemic, and a lot of it had to do with monetary policy, is that they were totally separate from what was going on in the rest of the world. And I think there's a lot of forecasting. I would say that's kind of based on the ideal world that the market wants, where the Fed is going to pivot, monetary policy is going to reverse, the interest rate raises are not going to be as high as we think, and they may not be taken into regard what's going on in the overall macroeconomic situation. They could just be looking at the stock market. And one of the things that I talked about with Lance, I want to say a few months ago, is that the Federal Reserve is not supposed to have any consideration for the stock market in the way in which they do monetary policy. We've created this new narrative in America to where the Federal Reserve, and I understand why, because everything's connected, is supposed to be worried about how the market responds to their monetary policy. But based on their mandate from Congress, they're only supposed to be worried about inflation and unemployment. They're not supposed to care about anything else. And therefore, if their policy negatively impacts the stock market, that's not supposed to be their concern, because they're only supposed to be worried about unemployment and inflation. However, we live in this multiverse where the market believes that the Federal Reserve is not going to do anything that's going to be detrimental to the market. And then therefore, because they believe that, they operate and they trade and they exchange money flows based on that perception. And so that's really what we got to try to figure out. So what I want to tell people is that this caught me by surprise, because I thought that the market was going to be green all this week until we go into next week, where we're going to have the rate raise. Big sell-off today. Let's see if it carries on through the rest of the day. Let's see if it also carries on through the rest of the week, because the day's just Tuesday. A lot can happen after this. However, this is why I want to tell people to make sure in this market, you're really managing your risk properly, right? It's not investment advice, but really make sure that you're managing your risk. Make sure that you have your head on straight, and don't put yourself in a position to where you're so heavily on one side of a situation that if you have to unwind it very quickly, like this morning, you don't have the ability to get out of it, right? Because I really believe that they were going to get a soft CPI and the market was going to run after that. And I'm telling you, a lot of people believe the same thing. And what we saw was the opposite. And this is one thing I tell people, that one thing about this market, if everybody's on one side of a situation, the market normally goes in the opposite direction. Hope you got some value from it. David W. Williams, also known as Diamond Dave. I'll talk to you later.